Hey guys, what's up? It's me, Jonathan, and welcome back to Money Talk. Today I'm going to talk to you about the first place you should be investing, and that's in retirement. And we're going to walk through how you should select your funds for actual maximum performance in your retirement account. If this is your first time joining me here on the channel, go ahead and hit that subscribe button, and you will be notified every time I upload a new video. Now, when you begin your investing journey, it's going to seem a little bit out of practice or a little bit confusing that you actually start with retirement. And the reason why you start with retirement is because with investing, you want to secure your future first and then start working on the present. So you start at the last option, which is retirement, and then you work your way back to the present. So when you first think about retirement, it's important for you to understand what options do you actually have as far as investing money into your account. So many of you may actually be with the employer, but there are a lot of things that employers do not tell you when you're going for onboarding and training to help you maximize this investment account for the long term. So many of you may be familiar with a 401k or have heard of it. So a 401k is the same thing as a traditional IRA. A traditional IRA is an investment account that takes money before you actually take taxes out of it. So this account is pre-tax dollars that you have direct deposited into the account to start your investment journey. So a 401k takes the money out of your check before any taxes are withdrawn and then deposit it into your 401k account for your retirement journey. Now, it's a pretty sweet deal, and many times the benefit of that is you have a lower taxable income. But on the long term, when you think about your investment account, how majority of that money will be actually growth, money that you didn't actually put in. And then when you think about you're in retirement, so every time you pull money out to live or to buy something nice or to do what you want to do while you're enjoying this money you've socked away, you have to pay taxes. So it's now important for you to get this structure right first on the front end while you have this time and opportunity available to go forward. So the first thing I want you to look into, instead of your 401k, I want you to check to see if your employer offers you what's called a Roth 401k. And a Roth 401k has probably it works the same as far as the money goes in after tax, but the requirements for the Roth 401k are phenomenal. Meaning, unlike a regular Roth IRA, you get to deposit the full 401k amount, which is $19,500 as of 2020. But you also don't have any income limits. See, when you open up a Roth IRA outside of your employer plan, that has income limits. Not everyone has the ability to just open up a Roth IRA. So it's very important that you first check to see if you have that Roth 401k option. The second piece you need to know about your 401k is if you get an actual match from your employer, the match portion that your employer does goes into a traditional 401k. So that match dollars that the employer does right now, it's not going into the Roth. So you want to work with your employer, you want to work with the dollar amount so that you understand that you're getting the maximum of the match, but you're also doing what you can to maximize that 401k. So that would be your first goal. Well, that's really good for a W-2 worker, but small business owners have great opportunities as well. So if you're a small business owner, you actually have an opportunity where you could get a SEP IRA, or you could start with a solo 401k. So if you're a one-person business, self-employed, you can actually open up a solo 401k, and actually, again, you can make that a Roth solo 401k. So that's a phenomenal opportunity for you, even as a small business owner, to really maximize your retirement. Now, the big thing about Roth is Roth means the money grows tax-free. So once you're in retirement, that big lump sum of cash that your money's grown to, every time you pull out, it will be tax-free. The key to investing for the long term, short term, regardless, is always going to be how much taxes or how can you mitigate the taxes you're going to have to pay. So this is important for you to get the structure of the account right on the front end because it will relieve a lot of hassle for you on the back end in the future. Number two, I want you to understand what you're going to put into this account. A 401k, an IRA, the account is only as good as what you put into it. So it's very important that you understand how the account actually works. And this is where the strategy that I keep telling you about comes into play. So with a 401k, the typical thing that you normally see is something called a target date retirement fund. A target date retirement fund has a pre-posed date and a pre-posed selection of stocks and bonds all put together working towards your retirement date. So I'm 35 right now. So my target retirement date based off these funds would probably be about 65, which takes us to the year 2055. So the target retirement date funds, the way this actually works is the fund puts a collection of mutual funds, stocks, and bonds into a fund. And every year I turn, it adds more bonds and takes away stocks from it. This process is called asset allocation. And the reason for that is, if you remember in my previous video where I talked about stocks and bonds is how you make money. Stocks is really what makes money for you. Bonds smooth out the ride, and it actually kind of slows up your earning potential. Well, in asset allocation, each year that I grow, meaning I'm 35 now, so next year when I'm 36, the target date retirement fund will automatically add more bonds and subtract more stocks. What this does is, in short, takes away my potential to earn. See, asset allocation is a great strategy when you're at a particular point in time. Meaning, I think you should be about 3 to 4 years out from retirement, and that's where you should change how much of your stocks, how much of your money is in stocks versus how much is in bonds. I prefer to use the method of diversification. Diversification means I'm going to have a little piece of bonds, but majority of my money is going to go in stocks. And by it being diversified means I'm going to have my money spread out over many different sectors so that if technology is up, then industry might be down. And so they offset each other. If automotive is up and housing is down, or if food, health, whatever the case may be, when I look at all the different sectors like those I just mentioned in the stock market, I can make sure that I have my money significantly spread at a good rate and I mitigate the risk. See, when I talked about putting all your money in one stock, that means you're hinging all your hopes on one thing. But when you spread it out over different sectors, that's when you start to say, hey, I know from a strategic standpoint that every year, everybody's not going to have a booming year. So how do I mitigate some of my losses that may occur? I make sure my money is spread out in other arenas, because the year that my money may go down in one area, it may also go up. That's how you invest for the long haul, and that's how you mitigate that overall stomach of risk. Now, moving on to number 3, how do you select mutual funds or start to make things happen? Well, when you start to think about how you can select a mutual fund, that's typically what's going to be into your 401k account. And it can be very, very cumbersome to try to understand, well, which one is good, which one is bad. Well, with your 401k, you have limited access to only a certain types of funds, depending on who your 401k account holder is. So you don't have full range of the stock market. I will first tell you, I want you to see if you have the option for index fund. It's not uncommon that this won't be an option. If you don't have an option for index fund, and specifically the total stock market index fund, then this is how I want you to select your mutual fund. I want you to go and look for mutual funds that, just like I said, are diversified, meaning they're across many different sectors. Second, I want you to make sure those mutual funds have been established for at least 20 to 30 years. And then lastly, I want you to look at the 10-year performance of that mutual fund, and I want it to have exceeded a 10% return. This can give you a good approach of what this mutual fund has done over the long term. That's how I selected my mutual fund, and honestly, that's how I ended up moving to index funds. I still use that same process. Now, lastly, for small business owners, you don't have the same opportunities as a W-2 employee. In fact, with your solo 401k or your SEP IRA, you have the full range of the stock market at hand. So I'm going to really suggest for you to focus on try to get that total stock market index fund, and then try to get you a total stock market bond fund. You can research and get this not only the account, but these funds at a Vanguard, Fidelity, Charles Schwab, those types of investor companies. They have those funds, they have the bond funds, but most importantly, they also have that expertise to help walk you through so that throughout the year you can manage and maintain and do what's a rebalance to the account. So I hope this information is helpful for you as you're starting to try to make your way through your investment journey, starting with retirement. And I can't wait to see you in the next video.